The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
It's Friday, the 9th of August. Welcome back, Jeremy. Good to have you here.
Hi, Gareth. Yeah, good to be here.
I think when we spoke about this time last week, we'd agreed that the coming week was going to be a quiet, gentle one with not much news. And then it started off, surprisingly, on the back of some shock news last Friday from the States. Do you want to talk us through what happened and what you think?
Yeah, our prediction was wrong almost immediately after we said it.
Yeah. Yep.
We got US employment data that triggered the Sahm Rule. So Claudia Sahm is a former Federal Reserve economist, now works for Bloomberg, I believe. But her rule that she formulated when she was at the Fed says that the economy has tipped into a recession if the jobless rate, based on a 3-month average, is a 0.5 percentage point above its lowest point over the previous 12 months, which in English really means that Friday's job report, which actually triggered the Sahm Rule, says that if her rule holds, the US economy is in a recession. And that was big news for people.
Okay, so that shocked the market and it's been sort of reverberating and bouncing around ever since, but stabilised a wee bit.
Yes, that was the spark, I think, on Friday that lit financial markets and just furthered this view that I think is ongoing, albeit it's stabilised a bit in the last few days, that the world's financial markets and the world's economies are undergoing a significant readjustment. And over the last month or so, we've seen a pretty dramatic fall in the price of things like oil and copper. I mean, double-digit percentage falls. Mm-hmm. We've seen a generally weaker dollar, and we've seen a NASDAQ 100 and a MAG 7, and particularly NVIDIA, moving around and behaving like microcap stocks. I mean, we had a several-day period where NVIDIA was moving around 5 or 10% a day, which is just incredible when you think it's capitalized at whatever it is, $3 trillion. So it's a pretty interesting and fast-moving and pretty volatile market backdrop, and the growing realization that perhaps the US is entering a recession. The soft landing hopes have been replaced by concerns about a hard landing, that we've seen a sharp decline in US 10-year rates at a time when we know that Japanese rates are going up. And we had this rather surprise 15 basis points increase in Japanese policy rates from 0.1% to 0.25%. Yeah. And it looks tiny and insignificant on its own. But the problem it reveals is this very sinister sounding thing called the yen carry trade. And the response to that late on Friday and then on Monday, when markets reopened in Asia, was pretty spectacular. And we saw almost an immediate double-digit, I think it was a 12% decline in Japanese equities. So in the space of about a week, we saw top to bottom something like a 28% fall in Japanese equity values, which is just phenomenal. And we saw a very sharp recovery at the same time in the value of the Japanese yen. So these are era-defining moments, potentially. It really is something that I think is worth trying to get one's head around.
Yeah, it is. And so Japanese rates went from 0.1% to 0.25%. So that's 15 basis points, but they're still a good 400, 450 basis points below equivalent rates in most of the rest of the world, especially the States. Yep. Is there any way that you can look at what happened back into last week or the beginning of this week and try and extrapolate for a 15 basis point move that's led to this level of pain and discomfort? If the carry trade were to narrow further, what might it mean? Is there any way you can look at that and try and assess it?
I haven't seen anyone attempt to quantify how big this carry trade is, but I think given how long it's been building and that it's based in the shadow banking hedge fund world where the scale of the yen debt that's been built up on the back of it must be measured in trillions of dollars, not billions of dollars.
Okay.
And secondly, these things tend to be quite reflexive and geometric rather than linear. And I think that's the reason why quite quickly after we saw the events of Monday that the governor of the Bank of Japan made it quite clear that he wasn't going to do the same thing again in a hurry. They made some statement around they weren't going to do anything more in terms of raising Japanese rates until market volatility had calmed down. Now,
Okay.
it did calm down quite quickly, but there's a heightened sense of foreboding around financial markets. So I personally don't think we're out of the woods here. But I think the question now is this yen carry trade that has been uncovered, is it similar to the regional banking crisis and the demise of Silicon Valley Bank last year? I.e., is it an event that policymakers can respond to, they can clear up the breakages, they can clear up the mess, and markets can move forward eventually? Or is it more systemic? Is it more like 07, 09 or 74 or 29? Is this going to play into a more wider global financial market crisis or recession? Now, it's way, way too early to assess that. But the difference, I would say, about the yen carry trade to the regional banking crisis, the most obvious thing is that it's unquantifiable and off balance sheet, whereas the regional banking crisis was all on balance sheet. You could see, if you looked hard enough, the regulators knew what was going on because they could find out very quickly.
Yes.
But here it's much more shadowy. I think it's probably bigger, and of course it's across currencies as well. So yeah.
Fine. Okay. So it's pretty difficult to know whether we've had a storm and it's now finished, or that was just the sort of the early gusts of what could be a really, really bad situation, or whether we're in the eye of the storm and waiting for the second part to come through. So it's, as you say, it's difficult to know where we are.
Yeah, and of course, as this week has gone on, yesterday we got some further US employment data, some jobless claims data, which seemed to indicate that the US job market was in a much healthier condition than the data from last Friday that we got. So, of course, as ever, there's more than one thing going on here, and there's some conflicting data around the place. But as far as global equity markets were concerned, the dispersion trade, the trade from the big tech to the Russell 2000, which had been triggered by the lead that Trump had taken in the polls a few weeks back, that's been put in abeyance now that we've got recessionary fears coming through.
Right.
So US smaller companies have basically been hit along with the rest of the equity market this time.
Okay.
But I think the most notable thing from a UK perspective is that basically we've been observers.
Yeah.
Our markets were weaker on Monday, but we were basically out of the eye of the storm. And the assets that have been affected by the deleveraging from the carry trade are essentially those assets that have been bubble-like year to date, including the Japanese equity market, which has performed very strongly, and of course the Mag 7, which were put into full reverse. So it's going to be interesting to see what the policy response is. In many ways, it's a shame that the Fed hasn't already started its cutting cycle. It chose not to do so in July, but hinting strongly that it would do something in September.
And that policy response sounds like the Jackson Hole meeting coming up soon is going to be a major time during which they can start to say a bit more about what they really think.
I think that's right. So we've got the Jackson Hole Fed Economic Symposium, as they call it, on the 22nd to the 24th of August. So I think it's coming at a good time. Although it's a Federal Reserve meeting, it's typical for the central bankers from other countries to be there. I would imagine that the UK, the ECB and Bank of Japan will be represented. And the title for this year's event is Reassessing the Effectiveness and Transmission of Monetary Policy, which is not a particularly catchy title, but perhaps they should retitle it, What Are We Going to Do with a Problem Like Japan, which is effectively what that title would say.
Yeah. Well, it's a pretty big problem, and the world's looking to them to solve it, really, or to help with some ideas. So, yeah, it'll be interesting to see what they come up with.
Yeah, but as I said, I think as far as the UK is concerned, the economy, I think, is still doing better than feared or probably expected by most people. And, we've had a few indicators this week. We've had the house builders report, and we've had companies in the consumer discretionary area making tentative noises that things are looking better. Wage growth is currently exceeding inflation in the UK, and inflation, we'll get confirmation of this next week, hopefully. It's continuing to sort of flatline around target at 2%. And companies are, by and large, reporting results that are in line with expectations.
I think that's right. And turning to the UK in terms of what people have been saying, there's been a real sense over the last few weeks, really, since the election, that the building and construction space is picking up very, very quickly. People are more optimistic. There's clear line of sight to the Labour government's plans around house building and significant activity in that area. And that's led to a lot of excitement, a lot of positivity coming out of that space. People talking about house rises. I think some of the survey organisations are starting to talk about increased activity in the housing market and expectations around that. All of it driven by the twin aspects of interest rates beginning to come down, mortgage rates following those pretty closely, and the government's plans for house building being pretty significant. So there's a lot of excitement, I think, building around there. But I think, you're right, more broadly, we feel like we're in a situation where most companies have been in difficult times for so long. They've cut their cloth, they've got their cost bases right, and they're working their way through. So performance is in line with expectations largely, and hopefully there are better times coming through. In terms of UK corporate news, on the Progressive side, we only had one client reporting news this week. We had an update from Sanderson Design Group, which is a soft furnishings business, and they are doing pretty well. They were giving an update for the 6 months to July. It's a January year end, so this was their half year. And a bit like the economy, they're sort of reflecting really in some ways the broader macro trends. They're seeing a strong performance from the States, but the UK's still been pressured. They've managed to get their costs down. They've got the business well under control. So they're doing okay. The overall performance was in line with expectations, forecasts maintained. And clearly we would hope, and they would hope, that there could be some kind of recovery in the UK business as this sort of building or property owning excitement picks up and people start spending on decorating their homes a bit more. So there's hopefully upside there. But it feels like the UK quoted arena, as you said, is sitting on the sidelines of these more turbulent global times and watching them largely from afar. And we're just hoping and waiting for our own domestic recovery to start to show through a bit better. So,
people like the house builders and the brick makers are all sounding notes of increased optimism. So Bellway today said it noted the rate cut earlier this month and the current low levels of consumer price inflation that provide an underpin for improving customer confidence. So there is a growing level of expectation for quite rapidly lower interest rates in the second half of this year. And certainly that's what bond markets are pricing in, but they're not always right, of course. But let's hope they are on this occasion.
Yeah, and in the meantime, that's certainly leading to a much higher degree of corporate confidence in the markets and preparedness to spend on things. So hopefully that'll continue. So great, that's all good. And what about next week?
Next week, we get UK unemployment data. Tuesday, I think that is. The expectation is it's going to be flat at a rate of 4.4%. So it could be interesting to see. We get inflation data on Wednesday, both from the UK and the US. I think the US figure is more consequential for financial markets, particularly because it's still above target. And the expectations there are for the July year-on-year rate to be down, but only modestly, to 3.2% from 3.3% in June. And on Thursday, we get Q2 GDP data for the UK. I think we should be getting a figure that's possibly approaching 1%, which doesn't sound a lot, but in the context of European economies, that's pretty good for right now. And we get retail sales data for both the US and the UK as well. For the US, July looks like it's going to be pretty flat. I think the UK, we should see some recovery, although it's hard to know with our weather, from a weather impacted figure for June.
Okay, great. Well, look, good to catch up as ever. Thank you for that. And look forward to next week, and we'll see how it all moves forward.
See you next week.
Brought to you by Progressive Equity.